Hi, this is Art Baker, instructor for Finance Lab 4125. This is our first class. Welcome. You may be viewing this session before or after the class. The first class will be a little bit unusual, but we'll get into cadence where I'd like you to watch the videos and try out exercises before the class, and then we will do them together in online sessions. This one, again, is going to be a little bit different. I'll do a little bit more hand-holding and kind of, we'll solve problems with you today on this video as well as in the class. So with that, let me switch on the slides. You will need Excel template that you can find on Canvas in addition to this lecture, just to follow it in a better way. It'll be pretty technical. I'll be guiding you through the template cell by cell. So, you'd like to follow me in Excel when you do that. So here are the slides for today's class. I'll be switching between the slides and the Excel exercise. But again, you can hopefully watch me and do the exercise at the same time. So we'll cover two chapters from Berg DeMarzo book, chapter 14 and 15. They both deal with capital structure, basically the mix of debt and capital in capital structure. Chapter 14 is a little bit simpler. It deals with perfect markets, and it shows that the choice of capital structure doesn't really impact firms' value, while chapter 15 is a little bit more advanced and it introduces taxes in this analysis. Again, we are not going to spend as much time going through concepts and covering the materials in chapters. We will be solving the data cases at the end of these chapters. And I repeat the data cases in my slides, but you can find them at the end of the chapters. The main theory behind the first part of the class is MM theorem number 1, which states that in perfect capital markets, the total value of the firm is equal to market value of total cash flows generated by its assets, and it's not affected by the choice of capital structure. Again, this is only true under perfect capital markets. And here are the kind of key conditions of the perfect capital markets. The main one that we'll flex is taxes. So again, the first part of the class will be assuming no taxes, and then in the second part, we will introduce taxes. So let's kind of quickly look at the case overview. I'll let you read it. Just again, I'll put it here for your convenience. So we'll go step by step through the exercises. And as you can see, the first one is to obtain information from fact set. So I will jump into fact set. I should have it open here. You may take a little bit of time to actually do that together with me. I'm using the web-based platform for FactSet. You can use the app that you download, or this just web-based platform. So let's start by going into company or security, and then typing in ticker HD for Home Depot. In the first step, we need to download balance sheet and income statement. We can find both of those under financials, and then there's income statement and balance sheet. I will start with balance sheet. Wait for it to download. Let me just double check that the settings are correct. So it's in US dollars, and then it shows us fiscal years. For balance sheet, I would want to do fiscal years and quarters, which would allow me to get the most recent date as well. So in the left bottom corner, Excel file showed up. I clicked on it, and here I have the financial the balance sheet for Home Depot in Excel. And what I'll do with it, I will open my template now, and I'll create a separate tab. I'll call it Financials, where I will copy and paste the information from FactSet. So I'll highlight the balance sheet information, and then I'm pressing Control-C and then Control-V in the new file, and copy and paste the financial information. And I'll also do the same thing with income statement. So for income statement, now we have it fiscal years and quarters in the top left corner as a setting. I will change it to fiscal years, just because it's easier for the income statement to deal with years rather than quarters. You don't want to mix those. For balance sheet, it's just, I wanted to pull the most recent balance sheet date. So I've selected fiscal years for income statement, and I will download it. Download it, and then I'll copy and paste it. I'll make sure to include the headings. Our headings may not align between balance sheet and income statement. It's just something that we'll have to check when we use the data. Let's look at the next step in our assignment. So I just did step 1B. Let's go back to step 1A. Find the current stock price and number of shares. That's pretty easy. We'll go to snapshot, pick 287.59, which is the current share price for Home Depot. And I'll type it in cell C6. So we decided to use 287.59 for stock price. Unlevered cost of equity is 12% in the assignment. Shares outstanding under snapshot. You can see two types of share counts. You have fully diluted and basic shares. Let's use fully diluted. It includes the dilutive impact of options and management compensation. We can talk more about it in class, but for now, I'll just pick fully diluted shares outstanding. Shares outstanding. Step 1C, to get the cost of that for Home Depot, go to credit analysis, debt capital structure detail, and select the latest yield on the outstanding bond with the shortest remaining maturity. So in fact set, under credit analysis, DCS detail, you can see notes and bonds. So you'll see the maturity date kind of in the middle of the table here. And you'll see two bonds with different coupon rates, but maturing in April of next year. And they have somewhat different yields. The yields are in column yield to worst, kind of the second one from the right. I'll pick 44%. I think it's just, there's difference depending on the coupon, but let's just pick one of them. So current yield to maturity is 0.44%. Now let's find, well, let's go to step 2 quickly here and see what we're asked to do. So let's find debt value on the balance sheet. So I'll look at the latest balance sheet. It has been simplified and standardized for us a little bit. So I'll just kind of highlight short-term debt on current portion of long-term debt and long-term debt. These are the values that we need. So for debt value, I will add up short-term debt and long-term debt. That gives me 41,750. You'll notice that I started putting in numbers not in millions or thousands, but in kind of actual numbers. The balance sheet is reported in millions, so I'll multiply the amount on the balance sheet by 1 million. So we'll kind of have everything in real units. So that value is 41,750,000,000. Equity value is pretty simple. It will be the stock price multiplied by shares outstanding. And the total will be debt value plus equity value. Now, the task was for us to calculate debt to equity ratio. Now it's fairly simple. I'll just divide debt by equity, and I get 0.1341. here's the first formula that we'll use. So we'll take unlevered cost of equity and then add debt divided by equity times cost of unlevered equity minus cost of debt. I'll put it in my Excel here. Cost of unlevered equity plus debt to equity 0.1341 times cost of unlevered equity minus cost of debt. And you get 1355. And the next step is to calculate the weighted average cost of capital under their existing capital structure. Let's see if we get that line in the formula here. Yeah, pretty standard formula. Again, remember, we don't have taxes in this analysis, so the WACC, weighted average cost of capital, is pre-tax. So it's just the weight of debt times cost of debt plus weight of equity times cost of equity. And here you've got, the calculations that we will do in Excel together. So let's start with equity. So weight of equity would be equity value divided by total value multiplied by cost of levered equity that we just calculated in step 3 plus the weight of debt, which is debt value divided by total times cost of debt. You get 12% even, which is, again, what we have on the slide here. This is the base scenario. And we'll now go into 2 other scenarios where we increase that or we decrease that. And we'll basically kind of go to the right or to the left of our base case on this chart. On the bottom scale, you have debt to value ratio. So the interesting thing, and you've probably seen this from your corporate finance class, that the yellow line is the weighted average cost of capital. So even though your cost of equity goes up as your company becomes more risky with more debt, because the weight of debt is higher and the debt is cheaper, the weighted average, the average of red and blue lines, the yellow line is flat. And that's what we'll see in these other scenarios. So we've just done scenario 0, and then scenario 1. We'll see what happens if Home Depot issues $1 billion in new debt to repurchase stock, or in scenario 2, what if the firm issues $1 billion in stock and then repurchases debt? And we'd like to illustrate that the weighted average cost of capital doesn't change. So the instructions pretty much say that, to calculate weighted average cost of capital and under these 2 scenarios. And let's do that. So you'll see that the debt value is a little bit higher by $1 billion. So we'll add $1 billion to debt, subtract $1 billion from equity. The total wouldn't change. And then we will recalculate levered cost of equity using the formula that we've just seen. And then we'll plug in that new cost of equity, levered cost of equity, into WACC formula And we should be seeing the same 12% WACC in this first scenario. Let's do that in Excel. So for that value, well, let me put in $1 billion here so that I don't have to type it into my formula. So I will say in the first scenario, our debt increases. So we'll start with 41,750,000,000 plus 1 billion. So that's new debt value. And then when we repurchase equity, here we'll kind of assume the same share price, and we'll have more complex scenario for that later in this class. But for now, let's just subtract $1 billion from the equity, assuming that we've repurchased equity for the same amount. And then the total is the same as in the base case. Debt to equity is now, debt divided by equity is 0.377, a little bit higher than 0.1377, a little bit higher than 0.341 in the prior case. And then so it'll be 12% unlevered cost of equity plus debt to equity ratio times unlevered cost of equity minus cost of debt, 24%. So now the cost of equity went up a little bit because the company has more debt now. And then let's calculate weighted average cost of capital without tax. So it will be cost of equity times the weight of equity plus weight of cost of debt times weight of debt. Very similar calculation as we just did. And it gives us 12% WACC, the same as in the base case. And now let's see, in scenario 2, the debt value goes down by $1 billion. So the debt value is 40 billion instead of 41 in base case, but equity is now 1 billion higher. The total doesn't change. This should be minus. It should be plus. The cost of equity, the levered cost of equity. Let's just do that in Excel together. So same billion here. Just call it in the same format. So that value is now lower by $1 billion than in the base case. The equity value is higher by $1 billion. Total would be the same. Debt to equity would be lower than in prior two cases. The levered cost of equity would be 12% unlevered cost of equity plus debt to equity ratio multiplied by unlevered cost of equity minus cost of debt. So the levered cost of equity is now lower than, let's say, 13.55 in the base case. And the WACC would be cost of equity times weight of equity plus cost of debt, which again we assume doesn't change here, times weight of debt. And it's the same 12%. So if you go back to our slides, and just kind of numbers substituted in the formula, but let me show you this summary tab. It basically summarizes a scenario. So in scenario 0, in the base case, we had $41 billion in debt, and then we increased it to $42 billion, and then we decreased it to $40 billion in scenario 2. And then the equity moved the other way. Obviously, the weight of debt is higher in scenario 1 and is lower in scenario 2. The cost of equity, levered cost of equity here, goes up in scenario 1, goes down in scenario 2, and that's really kind of, if you look at the chart, so scenario 1, the cost of equity goes up to the right, and then goes down to the left in scenario 2, but the weighted average cost of capital, the yellow line, is the same. So that's the summary of the first part of the class, where we looked at WACC under different capital structure scenarios, and we showed that it doesn't change in perfect capital markets.
It was interesting. I was trying to figure out, did Carol Tomei, when she upped the buyback, was that her view that things are better? Because when you do this, nothing is done idly by Home Depot.
Nothing is done idly by Home Depot. You know, we've bought back over $65 billion of our shares, over 51% of our outstanding stock.
That's incredible.
An average price of just over $50. And we look at the increment. Are we still creating value when we buy back the shares? And we think we are.
Welcome to the second part of today's class. We'll cover impact of taxes on weighted average cost of capital. It's chapter 15 in the corporate finance book. Let's jump into the case overview. It's really a continuation of what we've done in the first part. So let's calculate the tax rate for Home Depot, which we'll use to calculate tax shield from debt. So I'll call it the effective tax rate, and then we will take the income taxes from the income statement and divide them by pre-tax income, which I will calculate as net income plus taxes. So we'll see that the LTM, last 12 months, period had 23.6% tax rate, and then the prior 3 periods had same rate, and then it was much higher before the taxes changed a couple of years ago. So let's do average of all that in our template. So average tax rate. We'll follow the instructions here. In reality, I might exclude the 4th period here, 37%, because we know that it's been long time ago and it's not really applicable anymore, but I'll just follow the instruction for now. So we'll get a little bit higher tax rate than currently. And then new debt is just $1 billion. So we will see what happens if we increase debt by $1 billion, and then later we will increase it by $5 billion. Sorry, step number 2 here. All right, here's the formula for the present value of interest tax shield. And really what it comes down to is, in the numerator, we are taking annual taxes that would be avoided by adding debt. And then we kind of spell it out that, the interest itself is the interest rate times debt. And then you can see that the interest rate cancels out. So at the end of the day, and then we are kind of dividing it by the risk-free rate to use perpetuity formula. So at the end of the day, the present value of the tax shield is just the amount of debt, and we'll use new debt here, $1 billion or $5 billion. Multiplied by the tax rate. And that's why we had to go to the income statement and see what their tax rate is. In Excel, it's fairly straightforward calculation. So it's taking this $1 billion and multiplying it by the tax rate. So that's the present value of the tax shield. See, the number of shares, we'll take it from the first part of the class. So number of shares outstanding, we'll find it in cell C8 here. So shares outstanding, 1,082,000. I'll color code it green just to show that it came from another tab. And then I'll take the share price from earlier exercise as well. So, and that really gives us components for calculating the market value of equity before repurchase. So after repurchase, the market value of equity will be the prior value plus the present value of the tax shield. So that's what should be priced into the shares, and that should be the value of the company. So the value would increase by the amount of the tax shield. When we think about shares repurchased and the new share price, let's think about the market reaction to the announcement. And what we'll assume here is that on the announcement, the market immediately understands that the shares are more valuable now, and they trade up. And therefore, to buy back the shares from the market, the company will have to use the new share price and buy back a little bit fewer shares than it could have before announcement. So the new share price would be the new market value of equity divided by old number of shares. That's how much the share price will increase. And then at that price, the company can buy back the number of shares that they will calculate as this 1 billion that we're trying to buy back divided by this new share price. So it'll buy back 3,474,000 shares. So the new number of shares will be less by that amount. So we'll subtract that shares repurchased from the share count to calculate 1,079,000,000 shares, so a little bit less than they had before. But the main thing here is that share price. It basically shows you that the share price will be higher because the value of the tax shield will be included in it. For the book value of equity, let's go to balance sheet and find value of debt and book value. And here something interesting happened which you don't usually see. You see these red numbers in the common equity section. So basically after 2018, somehow their liabilities exceeded their assets on the balance sheet, and their equity became negative. So really the debt to equity using book value wouldn't be meaningful here, but you can still calculate it. So debt would be these yellow numbers I highlighted, the current short-term debt and long-term debt. And then we are issuing additional billion, so we'll add $1 billion to debt in cell C6 divided by common equity, which is negative, minus $1 billion. And before I finalize, one thing I need to keep in mind is that the balance sheet information is in millions, and this billion that I put in my Excel is, has 9 digits, so I will divide it by 1 million whenever I refer to cell C6. So book debt to equity ratio is negative 9.5, which isn't really meaningful. The market debt to value will be much more useful. So the short-term debt plus long-term debt plus $1 billion divided by 1 million. I'll put it in brackets. Divided by equity minus debt. And now maybe what I should be doing is multiplying balance sheet values by 1 million so that they're all in the same units. So that gives me 1376 as market debt to equity ratio. Let's quickly do the same thing for the fifth step. So just as repeat the steps for $5 billion debt raise, and then we'll see what happens to the share price. So the present value of the tax shield would be 5 billion multiplied by the tax rate. Market value of equity is actually the same. This is before any changes. And then the market value before repurchase would be number of shares times share price. And then after repurchase, we'll add the tax shield to the market value of equity before repurchase. So you can see right here that the market cap went up. And then same would be for the share price. So share price would immediately adjust, and you would divide the new market cap by the number of shares. So the share price went further up from 287 to 288.83. So shares repurchased, we would purchase 5 billion divided by the new share price, which gives us 17 million shares. And then the new shares would be the current shares minus shares repurchased. And so for the market debt to equity, I will take the book value of debt, and I'll multiply it by 1 million, and then I'll add new debt that we've issued and divide it by the market value of equity after repurchase minus the equity for the same amount that we would repurchase. And that will give us higher market debt to value, market debt to equity than in prior scenario, because you're issuing more debt. So you can see that going back to that chart. So as we increased debt to equity ratio, as we added more debt, our WACC went down, and as a result, our share price went up. So to review what we've done today, we've calculated WACC under different capital structure scenarios, and we showed that without taxes, it doesn't really change. And then when we introduced taxes, then we had positive impact from tax shield, and then our share price went up. This completes our exercise in Excel. I'd like you to follow that, try it on your own, submit the assignment, and then we'll have more discussion in class. Thank you very much, and I look forward to seeing you all online.